Welcome to today's Dealmaker event on the 2025 Outlook. I'm Lucinda Shen, deals reporter at Axios, and I'm coming to you today from New York City. Welcome to our audiences on Facebook, YouTube, X, LinkedIn, and on Axios.com. Join the conversation today on X with @Axios and #AxiosLive. For our next installment of our Dealmaker series, we'll take a look at the challenges and opportunities for corporate leaders, including founders and investors, navigating the post-deal transition. Our first guest is the Vice President of Corporate and Business Development and Ventures at Coinbase, Sean Agarwal. Hi, Sean. Thanks for joining us today.
Hey, Lucinda. Nice to see you.
So, Sean, I want to start with something that's happened recently for Coinbase. You've made the largest acquisition within the crypto ecosystem ever, the $2.9 billion buy of derivatives company Deribit. And so I noticed in the press release that you guys didn't mention earnouts or anything of the sort. And I'm curious if you can run us through the philosophy of how you think through those kinds of triggers within the deal structure.
Yeah, totally. So when we think about the deal structure, we actually work backwards by first thinking about what the integration strategy is. With any acquisition, people love to focus on the valuation and the deal and all the deal dynamics. But really, what determines success or failure in any acquisition is the integration and whether that's successful. And so with Deribit, our strategy on that front is to fully integrate the business and to create one integrated platform that supports spot options through Deribit as well as our existing futures platform. And so we wanted to ensure that there was alignment of incentives from day one between the teams. And something that we have found is when you have an earnout, specifically for the acquired company, you could have a misalignment of incentives because the acquired company is incentivized to sort of locally optimize for whatever the metric is that you're trying to drive through the earnout. But that local optimization could be at the expense of the broader integration strategy or vision that you're trying to achieve. And so that's generally how we think about it, starting with what's the longer term vision and working back to the deal structure, and then we'll devise the deal structure based on that.
So effectively, it creates kind of different incentive structures for the existing team versus the new company that you're acquiring. Coinbase has done 35-ish acquisitions at this point, so you guys are very used to this part of the business. Can you tell us, as you've gone through the process, what's kind of after the mergers kind of happened? How are you thinking about the cultural kind of data silos, all those aspects, and making sure that that gap gets closed?
Yeah, I think it's a super critical question because the number one item that we really focus on immediately from day one is cultural integration. The analogy that I use is a fully integrated business is sort of like open heart surgery. And so you're sort of taking this external organ in this business and implanting it into a very complex system, which in this case is Coinbase. And so we really need to make sure that all of the different pieces are talking to each other. That's not just the senior executive team, but that's also all of the functional leaders and the functional team members. And so, having the right IT systems, communication channels, but then also investing a lot in education so that both sides understand what communication norms are is really critical to actually achieving that cultural integration.
Yeah, what does that mean, communication norms?
Coinbase, for example, we emphasize quite a bit on what we call clear communication, and so it's a very specific type of communication, one that tends to be direct, shorter, pithier, versus longer form narrative. But you could see how that might clash with other organizations or companies that index more on like the art of the storytelling. So that would be one example. Another would be decision making. Let's say that a company has a different risk posture. And this is something that we encountered in Deribit in some instances because Deribit primarily operates ex-US. Coinbase has primarily operated in the US and Western markets historically and has been expanding internationally. And so they actually bring a wealth of experience in terms of how to operate in international markets. But in some cases, we need to reconcile differences of our views or opinions, and how we make decisions and what frameworks we use is really important. So at Coinbase, we use something called Rapids and PPSs, or problem proposed solutions. And these are just very simple frameworks that we use internally to make decisions. But we'll actually go through the process of educating an acquired company on how we use those documents, how to draft those documents, who should actually provide input on them, so that they can feel like they're speaking the same language as us on day one.
Do you think that after you acquire a company, there is a timeline within which you have to get these things done, right? Like getting everyone culturally integrated, after which it becomes more dangerous? Is there like a critical cliff?
Yeah, it's not like a hard and fast line, but generally, I would say within the first 180 days, the cultural integration piece is really, really critical. Just because after that point, a company can sort of get settled into its own culture, and there's no sort of adaptation. And when I say adaptation, I want to be clear, it's adaptation on both sides. Like, we as the acquirer also need to adapt and learn quite a bit from the company that we're acquiring, because there's a secret sauce, or some magic there, which has led to the company's success, and which is something that we actually want to learn from. And so it's really a bi-directional learning process that's really important. And it comes, frankly, from spending a lot of time together, having those open communication lines. And in our remote world, something that I have learned, especially the value of just in-person connection. When you're working with these large teams across many different geographies, it's really invaluable to get everybody together in the same place.
Do you have an example of where you ported over effectively, right? You buy the company, you buy the assets, but you also buy the people. Was there an example that you have from those 35 where you ported over the culture as well, or pieces of the culture?
Yeah. Yeah, absolutely. I think, if you go back to 2018, at that time, Coinbase was trying to get into the institutional space and build an institutional business. And, we had seeded a few organic efforts, but we really felt like we had an opportunity to leverage M&A to drive a coordinated inorganic strategy. And that led to, in 2019, the acquisition of Zappo's institutional custody business, which helped us seed Coinbase Custody. And then I looked to 2020 when we acquired Tagomi, which was at that time the leading crypto prime brokerage. And when we acquired Tagomi, that company and that team really came into Coinbase, and I would say taught Coinbase in many ways how to serve the institutional market. A very different client segment, very different client mentality. And we brought a team that sort of straddled the line in a very unique way, from folks that worked at HFTs and large banks, with also folks who were tech forward and understood how to operate within more of a Silicon Valley type tech environment. And a lot of those cultural principles that we acquired and brought into the company sort of formed the foundation of the institutional business as we have it today.
So I think what's interesting about M&A right now is there's a lot of changes over the last couple of years, both because of administrative changes, but also because of technology. As you're doing due diligence nowadays, and there's a lot happening within crypto, what stood out as risks that you've had to focus a lot more energy on, a lot of time on, than you previously had to?
Yeah, I would say the two that I point to are first, cybersecurity, particularly in the crypto space, and for businesses that custody user funds. There's a very wide spectrum in terms of standards and practices for how businesses actually set and implement their cybersecurity standards. And so we go through a tremendous amount of detail and diligence around that, particularly when we're acquiring a company. We don't expect that business is sort of mature across every dimension, but it's absolutely critical for us to understand where there's potential gaps and where we can actually lean in with a lot of the expertise that we have to help them improve. So that would be the first. And then the second is really around compliance and regulatory compliance. So onboarding for standards for onboarding various users, geographies in which that company serves users, how they work with their local regulators, all of those things, because the relationships that you acquire and the history that a company has with its regulators are sort of inherited in a lot of ways. And Coinbase always takes a compliant and regulatory compliant first approach. So that's really critical to our strategy.
All right, so regulation obviously has changed pretty rapidly. I am curious, you guys bought the largest, right? You made the largest crypto acquisition so far yet. Do you think that you will buy an even larger player in the coming year, let's say?
Uh, it's always hard to predict timing, but I would say definitely in the future. Right now, M&A in the crypto market is quite hot. And what we see is that with regulatory clarity, there's a lot of interest and activity in the space. And then we see real tangible use cases and benefits with crypto playing out before our eyes. And so, I always point to stablecoins and tokenization as areas that have a tremendous amount of interest. So I think the M&A market will continue to be robust, and you'll see more deals, you'll see bigger deals, and we're here for it. So,
Right. Is that where you're looking as well, stablecoins and that area?
yeah, among others, but that's definitely critical to our strategy.
All right, fair enough. Well, thanks a bunch for joining us today, Sean.
Thank you.
And next, we have a view from the top segment with Kristen Burkhalter.
Thanks, Lucinda. Good afternoon. I'm Kristen Burkhalter with Axios, and thank you so much to our sponsor, Cooley, for making today's event possible. I'm honored now to invite a partner at Cooley, Amelia Runyon Davis. Hi, Amelia. Thanks for joining Axios.
Thanks so much for having me.
I hope you're having a wonderful day. I think we should just dive straight in. We have some meaty things to get to. Is that okay with you?
Absolutely.
All right, great. So, Amelia, in your opinion, what are the most common post-deal challenges founders and leadership teams face when transitioning from a founder-led ownership to a private equity ownership?
Sure. I think some of the challenges kind of immediately out of the gate are having this new reporting structure. A lot of founders either had their own internal group that they were reporting, they're running the company themselves, maybe some VC investment that was a little bit more passive. And all of a sudden, you have a board that is typically controlled by the sponsor completely. And so you have a board that you report to, but it's really the sponsor that is kind of driving decision making moving forward. And so learning to operate in that environment where a lot of strategic and operational decisions are being guided by a sponsor instead of your direct team. With that comes changes in reporting cadence, maybe new performance metrics that you haven't driven the business towards previously, but are important for your sponsor's investment thesis. And so now you're doing different sorts of KPIs, different expectations around your business plan and meeting those operational goals. The other piece that I think can be really unique for founders once they are in a sponsor context is operating with leverage. All of a sudden, you are running a business that is subject to financial and operating covenants that may be entirely new to you as an operator of the business and have to kind of impact your thinking about where to devote resources and how to deploy your cash. And so those two things really can be the most challenging in a post-closing structure as very new for a founder who may have bootstrapped their companies or worked with VC investment in the past. I'll say another feature is that you've just had this big exit event. Many of your executives probably had a good liquidity event if you had incentive equity or people were invested in the business. And now you have to think about how to re-incentivize them moving forward. What are the new goals to drive the business? How do you make sure that people are aligned towards a new objective and that next stage of growth when you just had this exit? And so those are the things to kind of keep in mind as you're navigating that post-closing environment.
Fascinating. Let's go a little bit deeper. Can you give us some of the strategies that you have seen proven effective in aligning those expectations between founders and private equity sponsors during this really critical, as you mentioned, transition period?
Absolutely. I'll say I think this starts before the deal even happens, as you're navigating that bid process and evaluating different sponsors to partner with, one of the most important things is to make sure you're aligned on the vision for the future. And so, what got you to this place where you're at this exit opportunity may not be the same things that are going to be driving growth through the next frontier. And so, making sure you're partnering with a PE sponsor who's aligned on the vision is really the best way to set yourself up for success. Part of that is, how do you create a win-win incentive structure? And so PE sponsors will put in place a new incentive structure for your employees, often profits interest, maybe something that's new for your employees. They've never seen these before. And how do you communicate that throughout the organization to make sure everybody's driving towards the same goals? That really starts in the pre-closing, even pre-identifying which sponsor you want to work with phase. And so making sure that you kind of have those conversations up front, transparency in where the business is going, is the best way to set you up for success.
And I hope I'm right when assuming that you would agree with me on this, but every founder's relationship with their company has to be so deeply personal. How do you recommend balancing that emotional attachment that you mentioned with more financial and strategic focus that private equity investors often bring?
Sure. I think understanding that what got you to this place, you've grown this business and you've created a tremendous exit opportunity for you and your colleagues, is not necessarily where it's going to be going in the future. And so kind of recognizing this is a new phase, this is a new growth opportunity, being humble about where your skill set can take you and why you're partnering right now. What is the reason you're bringing in someone with a different expertise? It's to grow the business in a new direction. And so keeping that in mind as you're moving forward, that it's not necessarily somebody coming in to change the way your culture works or the way that you've really grown this business that belongs to you. It's somebody who can help you identify where your strengths are and keep growing those, but also maybe fill some gaps along the way. Maybe there's areas of your talent that need to be upgraded or need to be expanded, and can help you find those areas to drive further success. And so approaching it with that kind of open sense of curiosity of, I'm so proud of where I've gotten this to, and now let's go. Let's build this further, is the best way to kind of bridge that emotional gap between this is my baby and now I'm trusting it with somebody else.
Incredible tips, incredible strategies. I have one more question for you. I would assume there are many misconceptions founders have about private equity investment post-deal. Which one of those would you like to dispel?
I think there's a lot of misconceptions. I think sometimes founders or other organizations might worry that a PE sponsor is going to come in and just completely change the playbook, right? Replace talent, put in place all new systems. And that's not necessarily the case. That's certainly something that you can tease out as you're deciding which sponsor to partner with at that bid phase before you even decided to enter into a transaction. But one of the most important things to know is that they're investing in you. The PE sponsor is coming in and seeing a successful organization with a management team that is positioned to deliver even further growth. And so understanding that their goal isn't to replace the whole system and change course. It's really to continue progressing and add value in certain ways that maybe weren't achievable before. And so coming in again with that open mind, that level of humility of, here are my strengths and here's where I can help bring in other resources to really accelerate growth for me and my organization. I think that's the biggest misconception, is that the ship is going to change course, and that's not always the case.
Amelia, what an incredible answer. Thank you for dispelling some of those myths. And also thank you for this worthy conversation today. I enjoyed it. I appreciate you joining Axios today.
Thank you so much for having me.
And now back to my colleague, Lucinda.
Thanks, Kristen. Our next guest today is General Partner at VMG, Carl Stenmark. Carl, thanks for being with us today.
Happy to be here.
So, Carl, VMG is a really interesting firm. You guys invest both through consumer businesses as well as in tech businesses that help support those consumer businesses. So I think you've got an interesting perspective. VMG in particular has, as you mentioned earlier, does do a lot of M&A as kind of the exit pipeline, and that changes your perspective of things. Can you talk a little bit as kind of someone who's typically on the seller side and ends up going through the M&A path for your portcos? How do you ensure that your companies are a match for a potential buyer?
Yeah, I mean, I think this starts at the offset. So, after we consummate any deal, we host a kickoff meeting. A part of this meeting is really to get alignment with all the key stakeholders, most importantly, the founder, on what they're ultimately looking to accomplish. On the consumer side, that's typically working backwards from, 3 to 5 year time frame of a strategic exit. In that sense, what do we need to build over the next 3 to 5 years to be most attractive to the most number of strategic acquirers? And then we kind of break that down into really quarterly initiatives so we can accomplish that during that time frame. But yeah, I mean, I think ultimately it comes down to alignment and then making sure that, given our 20-year track record in consumer and selling, over 30 businesses, I think we have a good idea of what these strategics are looking for, and making sure that we're building businesses for those acquirers.
Yeah, you mentioned it's kind of like, it sounds like you're maximizing effectively the strategics that your companies could end up being sold to. How do you do that, right? Do you create like a kind of diagram of the potential buyers for a particular company, or do you have an ideal already? And then what are they looking for? Is there a catch-all for this or basic idea of what they might want?
Yeah, I mean, I think any of these folks are looking for growth and profitability that comes with either an innovative brand, an innovative product, or in more recent cases, technology that will accelerate their own growth or profitability. And so really what we're trying to do is understand from the most likely acquirers, what are the gaps that they're trying to fill and how do we stay focused while still achieving really deep distribution and strong velocity where a lot of these acquirers are looking to invest.
Right. And I mean, to your point earlier, there is kind of a range of potential acquirers that your companies could be sold to. Historically, you guys have sold stakes to private equity firms, to strategic buyers, right? Daily Harvest was bought by Chobani. Can you tell me, right, how is the communication for each of those different players? Does that tend to be different? And how you market your companies?
No, I think, typically we're always gearing for an exit to a strategic. I think what we've noticed over the last few years is that we're seeing private equity sponsors play pretty competitively with strategic. So let's say the last 18 months, we've sold 10 companies. 88 of those went to strategics, 2 of them went to private equity. I think what's interesting is even in the strategic exits, you see private equity competing on price, which is different. But I think the reason being is both parties are really looking for strong profitability. And so when we're exiting, you're seeing double-digit EBITDA margins as well as strong growth, which is attractive to both types of buyers.
Yeah. How do you stay, right, to your point, you're looking at M&A as a strategy from the get-go, and consumer can be a pretty volatile industry. I think a lot of brands are going after the next generation. Millennials are over now. It's all about the Gen Zs. And so how do you, right, there's a 3 to 5 year delay timeline between you guys investing and the asset being acquired. How are you staying on top of those trends?
Yeah, I mean, I think the trick of consumer investing, especially, is to avoid fads and back trends. And so I think what we're have constantly looked to do is kind of find that better for you product that is either, low sugar, high protein, where these are trends that are going to last, or in Daily Harvest's case, eating natural foods, and getting away from processed. But to us, these are things that are going to be around for 5, 10, 15, 20 years versus, trying to pick, a single ingredient, which could be a flavor of the day, or, and on the beauty side or personal care side, is it a particular, scent or formulation that is, hitting TikTok, that is driving crazy growth over 6 months, but can't sustain over, 3 to 5 years, to your point.
Okay, so longevity as a trend, as a thematic, rather than necessarily chocolate bars with pistachio in them. Are there differences as well for you as you're noticing and you're doing more tech investing between, right, what the tech investors want from an asset versus what the strategics want?
Yeah, I mean, I think, during the height of low interest rates, everybody was investing in growth, and that's what the strategics were looking for. I think over the last 2 or 3 years, we've seen kind of reversion to both buyers on the consumer and tech side optimizing, for growth and profitability, or at least really attractive unit economics. So I think that is staying consistent across both. I think when you come on to the tech side, probably one of the harder things to do is maintain alignment with all of the stakeholders. And so with consumer, we're typically the sole institutional investor. And thus, along the journey, we can have constant dialogues with that founder of, given the traction to date and the operational execution risk going forward, what is the best time to sell? And let's make sure that the end acquirer can still realize plenty of growth after their acquisition. On the tech side, I think we're looking for the same thing, but where the challenges come is now you're dealing with more stakeholders. And so in this case, you have a board of multiple investors with different cost basis. They have different underwriting criteria, different fund sizes, and how do you kind of maintain alignment of what is a success? And thus, when M&A comes knocking, are we all aligned on how aggressively to pursue that?
Yeah. Can you also maybe talk a little bit? I'm curious as well to hear, as a seller yourself, I think there's kind of an assumption that we usually cover, right, from the numbers perspective, how large a deal is. And so there's an assumption that you buy the company, or sorry, you sell the company, you guys get maybe earnouts over the course of a couple of years, and then you're done, you're dusted, your hands are wiped clean. You don't need to worry about whether or not overall after that the deal is a success. Do you feel like that's true? Do you have a vested stake in believing that a company should be more successful afterward?
Yeah, I think we're looking for all parties to win. And so I think we do not want to top tick an asset or top tick the market. In fact, we want to leave enough meat on the bone for the acquirer to also see tremendous success. I think that's because we're in it for the long game. And by them seeing success, you're not only maximizing the earnouts, which are becoming more and more common, or at least a rollover stake that more and more acquirers are looking for founders to maintain, but you're also showing that they can be repeat buyers of future assets. And a good example of this is, SC Johnson purchased Baby Gannix. They had a lot of success with that asset. 2 or 3 years later, they purchased Sunbum from us, and they've had tremendous success there as well. What we're typically trying to do is make sure we understand what are the strengths of those acquirers and how can they help accelerate growth. For example, a lot of times international is not an inherent capability of our founders or our management teams. And so we'll let the strategic go execute international markets for growth because, that's a big risk and requires a lot of capital for us to do that. Alternatively, can you leave, a new vertical or new distribution channel for the eventual acquirer, because it's a little bit harder for us to execute that, but might be easier for a strategic.
Great. With a final few seconds that we have left, I want to ask you, have you been seeing more due diligence has been changing the last couple of years? Have you seen certain topics come up more, whether it be cybersecurity, kind of tariff risk, those kinds of things popping up more?
Gross margin continues to be the primary area of focus the last 2 or 3 years. Obviously, tariffs have implications to gross margin. I think there is cybersecurity diligence, but I think that's been pretty consistent over the last 5 years. So no, I don't think diligence has changed all that much. Just what acquirers are looking for and the quality of assets that their underwriting has probably gone up, where if you're kind of in the middle of the pack, you're not seeing an outcome, and the strategics really are looking for market leaders, and thus I think you're seeing a lot of orphan businesses that can't find an acquirer.
Right. Great. Well, thanks, Carl, for joining us today.
Yeah, no, thanks for having me.
And for our final conversation, kicking it off to Axios Pro Deals senior editor, George Moriarty.
Thanks so much, Lucinda. Our final guest today is co-managing partner at Levine Leichman Capital Partners, Matthew Frankel. Matthew, thanks so much for being with us today.
Thank you for having me, George. I appreciate it.
Absolutely, and I'm super looking forward to the conversation. So, time's a little tight, so let's get right to it. As we've been discussing with our other guests today, we're really focused on the post-deal dynamic today. Everybody loves to talk about the excitement and cover the excitement leading up to the deal, but the real work comes afterwards, right? So to begin with, given the current volatility in the political and regulatory environment right now, does that have you reevaluating existing portfolio companies or sort of looking or at staging out exits differently?
Yeah, it's a great question, George. The answer to that question is yes and no. And by that, what I mean, let's start with the no. The reality is, being a private equity investor, we've lived through 4 different administrations from a political standpoint since 2017. So I think we're pretty used to changing environments. So I don't think what we've seen in the last couple of years has been all that radically different from different changes we've seen in the past, though I will talk a little bit about tariffs with respect to your question. As a general rule of Leichman Capital Partners, we are generally buying very resilient businesses that don't have a lot of risks from a regulatory standpoint or a political standpoint. So I would say from an upfront asset selection perspective, we're not putting ourselves in a position to get stung by some of the movements in the geopolitical landscape, the political landscape, or the regulatory landscape. So that's important to understand about the way we invest. With that said, and I referenced I would talk about this earlier, the tariff regime that we saw begin in April, that really has been probably something a little bit more jarring and different from what we've had to deal with in the past. So we have had to quickly pivot on things like supply chains, things on pricing, to make sure from a margin perspective, we're able to maintain our margin. So that has been a little bit different. And I would say that's where we are seeing the impact of this market in, change the way we're managing portfolio companies.
So along that line, though, so that's managing the active portfolio companies. Given tariffs, anything else, does that have you thinking differently about exits? Are you holding a little bit longer, looking at different opportunities or options? Or what's your thinking there?
Yeah, no, it's another very good question. We've actually gone the other way with your question. We've delivered more money back to our investors in the past 2.5 years than we ever have in our history, quite frankly. If you just look at the last 2 or 3 years, I think we've exited 12 investments. So it's been at a really brisk pace. And what we've seen in this market is really, let's take letter grades for the quality of a business. Let's say a C quality business, a B quality business, and an A quality business. What we've seen in this, not just since April or since the Trump administration came in, but I would really say since Q2 of 2022, where we started to see inflation spike, interest rates rise, more macroeconomic uncertainty. So that's been, I think, the delineation point where you've seen more headwinds on exits. So if I take those letter grades, in the last 3 years, if you have a C quality asset, don't bring it to market. No one wants it. It's not a question of price. If you have a B quality asset, it can sell, though you might not like the outcome quite as much from a multiple perspective. If you have an A or an A plus quality asset, what we've seen over the last 3 years is you can absolutely sell those assets and you can sell them at incredible multiples. And when I think about our experience in the last 3 years selling those 12 assets, 11 of those 12 we've been able to sell in the high teens multiple of EBITDA up to the low to mid 20s, which for those of you who don't live and breathe in the private equity world, these are exceptional multiples. So I think that selling companies so successfully has given us confidence. In fact, we signed a purchase agreement in one of our funds last week to sell a company at an incredible multiple. So we're not pulling back on that.
That's great. And, I'm sure there are a few people out there who don't live in the private equity world, but most folks probably speak that language pretty well. Along the lines of the ABC companies, I wonder a little bit, are there A, B, and C sectors that maybe there was a sector that you would have considered previously that right now, given, any number of factors, you've just stepped back from or aren't looking at?
Yeah. So look, I can only speak about our firm. I can tell you what I hear from friends at other firms, but with respect to our specific experience, we focus on 4 sectors. I would say 3 of them are incredibly well insulated from some of the volatility we've seen in the last couple of years. Those would be franchising, business services, and education and training. So from that perspective, we continue to lean into those sectors, and the environment we're in has not really changed our perspective. The 4th sector we focus on is engineered products, or said differently, manufacturing-oriented businesses. That is one. I wouldn't say it's off limits by any stretch of the imagination, but it's one I would say the level of diligence, the level of time we spend thinking about first, second, third order impacts of things like tariff, of things like regulatory changes, of things like shifts in the global supply chain. We are really thinking long and hard about those deals. And I would tell you, as an institution, we tend to be pretty risk averse. And to the extent that we view any of the current landscape to be a headwind to that company, we'd rather just not invest, even if it's at a lower multiple, than do a flying cannonball into the pool on something that we view as having material risk in the environment we're in today. So I would say on that engineer product space, we're probably a little less bullish than we were 12 months ago.
Great. That's very interesting. And, I'm sure that's something I'd love to come back to and find out when that might change again for you guys. But now, I would love to zero in a little bit on your firm and on that post-deal dynamic. You mentioned you've had some real successes. And when you look at the companies you've partnered with and other components of that transaction, what are the signs and signals and just things that you would share with people are sort of common themes in what turns out to be a successful deal for you guys?
Yeah. So, our firm's been around for 40 years. We've done a lot of deals. I've been a private equity investor now for 22 years. The one commonality that holds true in almost every successful deal is the quality of the management team. Having a great management team is, in my opinion, the number one most determinant factor in whether or not a deal is going to be successful. When you move past the quality of the management team, there are a whole host of factors, and it's going to depend upon the industry. But things like the organic growth profile of the business, how well the company executes on an M&A strategy or add-on acquisition, how well and the opportunities the company has in margin enhancement, whether that's through efficiencies in their operations or pricing. And I would say the last piece that will really determine success of an outcome is how visible the future growth of the business is, because that has probably the biggest factor in terms of the multiple of EBITDA that you'll sell a business for. So as an example, we're probably one of the most active investors in the world in franchising, specifically buying franchisors. We bought 31 franchisors. One of the reasons we love those businesses, and there are a whole host of them, is through their signed but an open backlog of franchisees, meaning a franchisee has paid their franchise fee and they're somewhere in their opening process. It can give those businesses 3, 4, even 5 years of visibility for future growth. Those are the types of businesses you'll see in the market commanding, exceptional multiples, because the buyer can have a very high degree of certainty and significant growth in their financial model.
That's really interesting, because franchises, you hear a lot about some troubled franchise operations. So understanding, how you guys find that success is interesting to me. Now, I did say and warn you ahead of time, part of the fun of this with about 2 minutes left as a journalist is, learning from our mistakes, right? Like we all have something go sideways, a deal goes sideways. When that happens to you, take us inside managing when you start to see a deal go sideways and working with those partners to try and, rectify it, right? And how you might take that away when things turn.
Yeah. So look, we have had deals go sideways like anybody else, right? I would never claim otherwise. With that said, we have probably one of the most unique statistics in private equity for a long tenured firm, which is we've never lost money on one of our realized control deals. So under that landscape, let me explain to you why, and let me tell you, I think probably one of the biggest determinant of what happens when a deal goes sideways. And the answer to that's leverage. Okay. Is if a business's earnings start to fall and it's a highly levered business, the impact on the business and the deal is significantly impacted. It starts with normally a cash crunch or a liquidity crunch. And then oftentimes the lenders in the business will be doing their fiduciary responsibility to protect their capital. They'll force restructurings, they'll force bankruptcies, they'll bring in management consultants that at a time when the business is cash constrained is even consuming more cash. So that's generally what happens when a private equity deal goes sideways or goes poorly. Now, if I juxtapose that with a business with no leverage or less leverage, the sponsor and the management team have a lot more breathing room to fix the problem. They get the time they need to take that free cash flow, pay down the debt, and whatever broke within the business to have time to fix it. And I would say our strategy that utilizes really low third-party leverage, that is one of the key factors why we've never lost money in one of our realized control deals. Now, in terms of things to watch out for, I would encourage anyone listening to be very focused on what I'll call the windshield of the car versus the rear view mirror. That if you're relying on monthly financials or quarterly financials where 30 or 90 days have already passed before you evaluating how your business is doing, it's very likely you could get caught in a trap and not being able to react quickly enough to challenges in your business. We focus very much on forward-looking KPIs or key performance indicators, both on the revenue side of our business and the cost side of our business. So if we see an issue, we are getting on that issue immediately before it metastasizes into a larger problem. So I think that's really important in managing through tough times.
And that's there's a couple songs out there about being the windshield and the bug. So I think that gives a lot of good insight for people to take away. So Matthew, this was really good. I wish we had another 10 minutes to go, but I can't thank you enough for taking part today. If you want to just say any last word for our listeners, and then I'm just going to say thank you.
Yeah, no, George, appreciate having me on, and to your listeners, best of luck navigating through this environment.
All right, take care, everybody. That was Matthew Frankel from Levine Lakeman. Take care. And thank you all for joining us this afternoon for another Axios Dealmakers event that's made everyone smarter, faster. For more on what's next in deals, visit axios.com/newsletters. Thank you all so much for joining, and we'll see you next time.